Imagine turning just $100 into $1 million. It sounds impossible, but with the power of compound interest, this financial miracle can become a reality. In today's video, we're diving deep into one of my most popular shorts, The Power of Compound Interest, which has garnered over 20 million views and thousands of comments from curious minds eager to learn how they can achieve such incredible financial growth. By the end of this video, you'll understand how compound interest works and how you can start applying it to grow your wealth exponentially. Stick around, and you might just discover the secret to becoming a millionaire. Understanding compound interest, the secret to exponential growth. Compound interest is often called the world's eighth wonder for a good reason. It's a simple yet powerful concept where the interest you earn on your money starts earning interest itself, leading to exponential growth over time. To understand this, let's compare two people: Timmy, who saves $100 but spends all his earnings, and Billy, who invests $100 and lets compound interest do its magic. While Timmy's money remains stagnant, Billy's investment grows exponentially, eventually turning that modest $100 into a staggering $1 million over time. How does compound interest work? Let's break it down. When you invest money, you earn interest on your initial investment. With compound interest, you don't just earn interest on your original $100, you earn interest on the interest accumulated over time. For example, if you earn 10% interest annually on $100, you'll have $110 at the end of the first year. In the second year, you'll earn 10% on $110, giving you $121, and so on. This process of earning interest on interest continues, accelerating the growth of your investment. Why time is your best friend? The key to maximizing compound interest is time. The longer you let your money compound, the more powerful the effect becomes. Imagine you start investing at age 25 with just $100, and it compounds annually at a 10% interest rate. By the time you're 65, that $100 could grow to nearly $45,000. Now imagine if you added $100 every month to your investment. You could end up with over $1 million by retirement. This is the magic of compound interest at work. Stocks, the vehicle for growth. Now that you understand how compound interest works, let's talk about the vehicle that Billy used to grow his net worth. Stocks. Stocks represent shares of ownership in a company. When you buy a stock, you're essentially buying a small piece of a business. Over time, as the company grows and becomes more valuable, so does the value of your stock. There are two main ways to make money from stocks. 1. Dividends. Some companies share their profits with shareholders through dividends. If you own stock in a company that pays dividends, you'll receive regular payments just for holding the stock. For example, if a company earns $100,000 in profit and decides to distribute it as dividends, shareholders will receive a portion of that profit based on the number of shares they own. 2. Capital appreciation. This is where the real magic happens. Capital appreciation occurs when the value of your stock increases over time. For example, if you buy a stock for $50 and it grows to $100, your investment has doubled. This increase in value is where most of the wealth in the stock market is generated. The importance of long-term investing. To truly harness the power of compound interest, long-term investing is key. Unlike short-term investing or day trading, which can be risky and stressful, long-term investing allows your money to grow steadily over time with much less effort. By holding on to your investments for years or even decades, you give compound interest the time it needs to work its magic. One strategy to simplify long-term investing is dollar cost averaging. This means consistently investing a fixed amount of money into the stock market, regardless of whether prices are high or low. Over time, this approach smooths out the ups and downs of the market and ensures that you're buying more shares when prices are low and fewer shares when prices are high. It's a low-stress way to build wealth over the long term. Diversification, protecting your wealth. Diversification is another crucial principle of long-term investing. Instead of putting all your money into one stock, you spread it across a variety of investments. This reduces your risk because if one stock performs poorly, others in your portfolio may perform well, balancing out the losses. For example, imagine you invested all your money in a company like Blockbuster back in the day. While Blockbuster was once a dominant player in the video rental industry, it eventually went bankrupt, leaving investors with nothing. On the other hand, if you had diversified your investments across several different companies or sectors, the failure of one company wouldn't have wiped out your entire portfolio. Investing in index funds is a simple way to diversify. An index fund is a type of mutual fund that holds a broad range of stocks, representing the overall market or a specific sector. By investing in an index fund, you're essentially buying a small piece of many different companies, which spreads out your risk and increases your chances of long-term success. The power of starting early. One of the most important lessons when it comes to compound interest is the power of starting early. The earlier you start investing, the more time your money has to grow. Even small amounts can turn into substantial sums if you give them enough time. Let's say you start investing $100 a month at age 25. By the time you're 65, with an average annual return of 8%, you could have over $350,000. If you wait until age 35 to start, you'd only have around $150,000 by age 65, a significant difference, all because you started 10 years later. Avoiding common pitfalls. While the potential rewards of investing are great, it's important to be aware of common pitfalls that can derail your financial goals. One of the biggest mistakes is trying to time the market, buying and selling based on short-term price movements. Not only is this incredibly difficult to do successfully, but it can also lead to emotional decision-making, which often results in buying high and selling low. Another pitfall is neglecting to diversify. Putting all your eggs in one basket might seem like a good idea when one stock is performing well, but it can backfire if that stock takes a downturn. Always remember the importance of spreading your investments across different sectors and asset classes. Using technology to your advantage. Today, technology makes it easier than ever to start investing and take advantage of compound interest. Platforms like Webull allow you to buy fractional shares, meaning you can start investing with as little as $5. You don't need to wait until you have enough money to buy an entire share of a stock like Apple or Tesla. You can start small and let compound interest do the heavy lifting over time. Start your journey to $1 million today. The power of compound interest is truly incredible, and it's something that anyone can harness with the right mindset and approach. By starting with just $100, consistently investing over time, and allowing compound interest to work its magic, you can potentially grow your wealth to $1 million or more. Remember, the key is to start early, invest regularly, and stay patient. The journey to financial independence isn't a sprint, it's a marathon. But with the power of compound interest on your side, you'll be amazed at how quickly your wealth can grow. Outro. Thanks for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more content on personal finance and investing. And if you're ready to start your investing journey, check out the link in the description to get started with Webull. You'll even get some free stocks just for signing up. Finally, if you're thinking, this all sounds great, but I don't have the extra money to invest, don't worry. Check out my other video on how to become a millionaire even on a low salary. See you next time, and take care.